Hello, my name is Joe Hoyle, and I'm one of the authors of Financial Accounting, the second edition, and I'm here today to work with you on doing Chapter 9, Problem number 9, which is a periodic inventory system. We want to use the information in Problem 9 of Chapter 9 to show you how to do periodic FIFO and periodic LIFO. If you've read the question, you know that Montana Company is first, and they're going to use periodic FIFO. We're going to do this for 2 years. We're going to start by doing year number 1, and then we'll do year 2. The problem then asks what the proper net income for the Florida company, the other company, is based on the information that you determine. In this particular problem, it's a periodic system. So therefore, if it's a periodic system, 2 things should come to your mind. One is they have to take a physical inventory at the end of the year in order to know how many units they have. Without that, they don't know how many units they have. And secondly, the determination of cost of goods sold is done by a formula. You take the beginning inventory, you add in the units that you purchased during the year, and then you subtract out the ending inventory. And that will give you cost of goods sold. That formula is very important when you're doing a periodic system. Beginning inventory plus purchases less ending inventory. Now, what do we know in this question? Well, we know in this question that they begin year 1 with 10,000 units of inventory, and those units cost $6 a piece. So the beginning inventory is $60,000. That's information given to you in the problem. Then during year 1, they purchased 20,000 more units, and there has been inflation. So now the cost is not $6, but it's $8, and that's $160,000 more dollars of inventory. So if you add those 2 up, that will give you the total inventory for the year, $220,000 worth of inventory. Beginning inventory plus purchases gives you the $220,000 figure that you have for that period. Now, they would have to count the inventory. How many units did they sell? The sales for the period was 20,000 units. Well, you can see right here that they had 30,000 units, 10 at the beginning, 20,000 more. So therefore, if their sales were 20,000 units, they should have left 10,000. So ending inventory is at 10,000 units. The question, this always becomes the important question in a periodic system. How much is the cost of the ending inventory? The true answer is that we do not know. So we have to make an assumption. The assumption that they're making here is that we're using FIFO. And FIFO always peels off the inventory this direction. You use the first inventory first in, first out. So when we're talking about what is left, it's always the last units. First in, first out, what's left? The last unit. So if there's 10,000 units in the ending inventory, we're going to assume that they come from this last batch, and this last batch cost $8 a piece. That's using FIFO. So that 10,000 at $8 a piece, right there is where you applied FIFO. Everything else was a set formula. 10,000 units at $8 a piece is $80,000. So the Montana Company for year number 1 has cost of goods sold of $140,000. Beginning inventory plus purchases less ending inventory, and the cost of that ending inventory was determined by using FIFO. Now, let's take the same problem and go to year 2. We still have to do beginning inventory. We still have to have purchases. We still have to subtract ending inventory to get cost of goods sold. The beginning inventory came from last year, so that was the 10,000 units at $8 each, or $80,000. You got that from year 1. That carried over from year 1. In the second year, they purchased 30,000 more units. Once again, we have inflation, and so those units now cost $9 a piece, so $270,000. How much are the goods available for sale in year 2? $80,000 is your beginning inventory. $270,000 is your purchases. So therefore, the goods available for sale are $350,000. How many units did they sell? What were their sales? They sold 30,000 units during the year. Well, you can see right here, we have 40,000 units. 30,000 of them got sold. So therefore, how much is left? 10,000 units must be left. That's your ending inventory. So ending inventory are those 10,000 units. And then once again, we get to where FIFO comes into play. What is the cost of those ending inventory? As I've already said, in FIFO, you peel them off in that direction. So whatever's left is the last one's left. What did the last ones cost? The last ones cost $9 a piece. 10,000 at $9 gives you a cost of $90,000. How much, if the Montana company is using FIFO, periodic FIFO, cost of goods sold is $260,000. Now what we're going to do next is compare that to the Florida company. Now you can see with the Florida company that the Florida company is using periodic LIFO. It's still a periodic system. So you'll still start off with beginning inventory, you'll add purchases, and you'll subtract ending inventory, just like we've done before, cost of goods sold. That's a periodic system right there. This again, though, don't forget, is year number 1. So beginning inventory is 10,000 units at $6 a piece, that's 60,000. In the first year, we're back to year 1, 20,000 units were bought at $8 a piece, that's 160,000. So your goods available for sale are 220,000. How many units did you have? You had 30,000 units. What were your sales? In year 1, you had sales of 20,000 units. Says that in the problem. Therefore, how many units do you have left? You have left 10,000 units. So your ending inventory is 10,000 units. Now, what did they cost? You're now back to the periodic problem. If this is a LIFO system, you peel the inventory off in that direction. Last in, first out. So these are your last ones, and they go first. What is left at the end of the year? In LIFO, it's always the first ones that are left. Last ones are gone, the first ones are still here. So which is the first 10,000? Right there is your first 10,000. You make the assumption. Now remember, this is an assumption. We don't know which units are left. But we assume it's the 10,000 at 6. That's $60,000. So in year 1, you have a cost of goods sold of $160,000. That's different because FIFO and LIFO show a different picture of the reporting company. We'll finish this one up then by looking at year 2. Again, we're using periodic LIFO. Because it's periodic, beginning inventory plus purchases minus ending inventory. What was the begin? And of course that gives you cost of goods sold. What was beginning inventory? If you go back to year 1, it was 10,000 units at $6 each, or $60,000. That was what the previous slide showed. What did they purchase in year 2? They purchased 30,000 more, but now they cost $9 a piece, or $270,000. That's a total of $330,000. How many did they sell? The sales, according to the problem, were 30,000 units. If you had, as you can see right here, 40,000 units, and you now sold 30,000, what do you have left? You have left 10,000 units. So the question is, if it's LIFO, which 10,000 do you assume are left? In LIFO, you peel them off in this direction. These are all gone. You assume that, and these are left. So this is the bunch that you believe is left. You have 10,000 units left at $6 a piece. That's $60,000. What was your cost of goods sold? Your cost of goods sold was $270,000. Notice that Montana for year 2 had a cost of goods sold of $260,000. Florida has a cost of goods sold of $270,000. The problem says that Montana has a net income of $100,000. Florida, as you can see, has a cost of goods sold that's $10,000 higher. So if you have cost of goods sold that's $10,000 higher, that leaves you less net income, and the net income for Florida is going to be $90,000. It's $100,000 for Montana. It's $10,000 higher. Cost of goods sold is. That's an expense. It brings your net income down, and therefore Florida's reported net income is $90,000. If you can do this problem, you should be fine in working with periodic inventory. It shows you how a periodic system works, and it shows you the difference between making an assumption of FIFO and making an assumption of LIFO.